Welcome to this new Compass session by Santander Asset Management. I'm Delfina Pérez, Head of Global Markets Content, and it's my pleasure to share this session with José Mazoy, our Global CIO.
Welcome, Delfina.
José. And with Jacobo Ortega, our CIO for the European markets.
Thank you,
Good to see you, Jacobo.
Sure.
So many things have been going on in the market since our last session. In terms of tariffs, well, if we attend to the last letters and looking into the 1st of August, the average tariff would be closer to 20% than the 10-15% we were considering. The one big beautiful bill has already happened. That implies a higher fiscal deficit for the US. Economic data in the US for the time being is mixed. The economy is resilient, but is pointing to economic slowdown. And if we look at the geopolitical stress indicators, they are not at maximum, but they are still at high levels. But yet, the US market has been continue gaining since the lows of April. And just yesterday, the S&P 500 and the Nasdaq hit new all-time highs. So let's go to the point. José, who is buying the US market?
Well, I think you explained it very well. All these things that have been occurring in the market have really created a wall of worry.
Mm-hmm.
And the market has been super efficient in climbing this wall of worry, right? It has been extremely resilient. After the Liberation Day, what we saw is that the market hit around 5,000, the S&P in particular. But ever since then, we have seen a tremendous rally of almost 25%. And as you say, reaching all-time highs, right? This has been a very unloved rally because a lot of asset allocators have been positioned on a very cautious way, mainly due to all the factors that you have explained. So the positioning has been very light, especially from discretionary type of investors, either hedge funds, asset managers, CTAs, and so on. And what we've seen is that more on the passive investment type of side. And what do I mean by passive? Passive is, for example, buybacks from corporates. You can have retail adding into their 401ks, as well as gamma hedgers that need to hedge the short volatility exposures, have been relentlessly buying the market and giving a support to it, right? So that's one of the reasons why we've seen such a tremendous rally of around 25% on the S&P and reaching, as you say, all-time highs.
Mm-hmm. And what about valuations in this context? Because that is something that we monitor very closely. And according to our analysis, they are above the historical average. So could that be a reason for the different approach between retail and the rest of the market when buying into the market?
Absolutely. I think that when you take into account, for example, the S&P 500, valuations according to historical averages, they are above the 90th percentile in terms of valuation. So certainly for more professional type of investors, discretionary investors, these are very testing type of levels, and that's why they have had a more cautious stance when it comes to investing in the market. When it comes to retail investors or, as I said, gamma hedgers and so on, they are a little bit less price sensitive. And given the news that we've seen on the artificial intelligence front, for example, we see that that has basically not been a holdup for this type of investors.
Okay. Well, but although the US market has been outperforming since April, May, but the leaders are the Eurozone equity markets. I mean, if we look at DAX in Germany or IBEX in Spain, they are gaining more than or around 20% year to date. So what has been going on in the Euro markets and still steam to go further?
Well, I think the main outperformance came during the first quarter that we've seen. I mean, some of the factors that we wrote on our annual outlook started to come into fruition. Let's say fiscal support from Germany and the outcome of the elections. That's one key topic. Money coming back into Europe. I think year to date we have seen inflows north of 45 billion on the equity space. And also, I mean, I think there has been a strong delivery on earnings from several sectors. I don't know, but financials, defense, utilities. So there was some sort of tailwind during the first quarter. It is true that since the the rebound of US markets in mid-April, I mean, Europe has been probably trading sideways. I think that, or from our understanding, there's still room for Europe to improve in the second half of the year, and there are many reasons for that. One definitely is EPS inflection point. I think, I mean, the forecast for 2026 is north of 10% EPS growth. We still think that more fiscal support will come from other countries, not only from Germany. And also, I think the structural underweight that we've seen in global investors into Europe, I mean, is little by little improving. So we tend to think that flows will keep coming. And even though there has been some sort of setback in the short term, and I also, I mean, you mentioned August 1st, that is going to be a key milestone. I think after that, when people reassess their stance, I think Europe could still outperform, the global markets in general.
Okay, good news then for the Euro markets. You mentioned, Jose, artificial intelligence. Technology, artificial intelligence on top or around it in the US market is something very, very different. And we are like in a context that we cannot compare with anything else. So what are our views on the impact of artificial intelligence and technology overall the US market?
Well, absolutely. I think that this is a secular trend that is certainly pushing the market forward. At the beginning of the year, we saw a little bit of fear with regards to tech exceptionalism, right? And we saw it with the price of NVIDIA falling by approximately 30% on the back of the news of the release of DeepSeek, and also the fact that there were some big tariffs implemented in the case of China. But little by little, a few factors have really pushed the price of NVIDIA and all the tech sector forward, right? One of them was, for example, the release of the first quarter results by NVIDIA that were not very much affected by the restrictions that were put on China, right? So that's one of the factors. But I think that overall what we see is that there is a clear advancement in the need for compute that you see with artificial intelligence, the LLM models, right? So one of the biggest things that we've seen this year is the need to do now reasoning, and reasoning needs much more compute, right? And just to give you some numbers, for example, Microsoft processed more than 100 trillion tokens, which is a 5-fold increase in Q1 relative to a year ago. If we take Google, for example, it has had a 50% jump in the amount of tokens that they process.
50%?
50%, yeah. No, it's pretty big, right? And if you take the new models that are going to, that have been released or are going to be released, such as Claude 3.7 or Grok 3, you see that basically they are going to need 10 times more compute than they were, than the previous models, right? So this has, of course, this has to be accompanied by a big capex expenditure, both from the companies that produce semiconductors. So we've seen news, for example, from TSMC that they are going to basically increase their capex expenditure by 42 billion, right? Which is a huge number. It's like a 40% year-on-year increase. Or the hyperscalers that were investing of the order of 200 billion in 2024, they are going to increase in 2025 to 300 billion. So overall, you see that there is a huge amount of investment that is going to be coming into the market. Of course, then we need to see earnings delivering, but we're actually seeing it, right? So the market is becoming very optimistic with the AI trend.
Yeah, the figures are impressive, and actually because artificial intelligence is already a reality. I mean, companies are already using it. We are using it at some in our investment process and analysis.
We're using it everywhere to make our process more efficient in our investment process, but not only in investments. We see it in all the different jobs that we have at Santander Asset Management. We use these models all the time, right?
Yeah, and customer journey,
absolutely,
all through the business. So, Jacobo, you mentioned the fiscal plans in Eurozone, particularly in Germany. That is a game changer. That is very, very
completely change of stance. It never happened in periods that they were not going through a recession. So that's quite a change in stance.
And that is, I guess that is going to help a lot the European companies, the Euro companies, German companies, plus the ECB has been cutting rates. There has been no pause.
Yeah.
Well, maybe we have pause in July. We're expecting a pause in July, but just a pause after 8, 5 or 9 cuts. So if we want to invest in European or Eurozone companies, we have the equity market, but we also have the credit market. We also
Definitely.
can look at fixed income.
Yeah, totally. We really believe that the fundamentals on the European corporate sector are as stronger as they have never been. So for us, I mean, European investment grade is an asset to still be owned. I mean, some people may argue that, for instance, spreads are a little bit tight, but the reality is that is supported by strong fundamentals on one hand, and on the other, strong demand. I mean, we've seen year to date inflows into the European IG plus high yield space north of 30 billion. Again, I mean, it's quite a big number, and we don't foresee any strong, let's say, sort of headwind against this to be continued. So for us, I mean, taking into consideration where rates are, when inflation, I mean, let's say forecasts are going to be on the next years, we still think that IG is an asset to strongly be owned, and that's a core part of our multi-asset portfolios.
Yes, attractive carry.
Absolute yield.
Yeah. So with all this backdrop and still waiting for the Fed to start cutting again, we're still on pause because we have to look at inflation, we have to look at growth in the US, the impact coming from tariffs, fiscal plans in Eurozone, levels of growth in China, which is doing quite well, growing at 5% or so. What is our current positioning in our investment portfolios, Jose?
Going a bit asset class per asset class, what I would start with is with the equity risk, which is certainly one of the main driving factor on a portfolio. And what we see is, for example, our process has quant signals and fundamental signals.
Yeah.
Our quant models are already indicating a more bullish stance when it comes to equity risk, right? However, from a fundamental point of view, I think that we're a little bit at a crossroad, right? So you mentioned before valuations, right?
Mm-hmm.
So valuations are quite stretched, right? And well, up to a few months ago, there was quite a bit of a tariff uncertainty. This has dissipated a little bit, right? So I think that the worst of tariffs has passed, right? So that would be a more bullish indicator when it comes to equity risk, right? Also, we see that some of the sentiment indicators are turning around, which would also indicate you a more bullish stance. So on the one hand, we have the quantitative signals that tell us, okay, you should overweight equities, but then from a fundamental point of view, stretch valuations and still quite a bit of risk on the horizon, we prefer to have a neutral stance when it comes to equities. When it comes to fixed income, we think that there's more room to run, right? On the one hand, all the fiscal stimulus, of course, has lifted interest rates, especially at the long end. We see the 30-year rate touching a few times the 5% level. But I think that it has stabilized around that level, and it has had the capacity to absorb those news coming out from the fiscal stimulus stance, right? So going forward, we believe that at the long end, rates are going to be stable. When it comes to the Fed, we see that they still have in the dot plot still two cuts coming in, right? So, but still, we need to see what happens with inflation and growth. And also the summer is a good moment to be invested in fixed income from a seasonality point of view, right? So when it comes to fixed income, we are more constructive and overweight in turn. And finally, I mean, I just gave a bit of a speech around AI. Basically, there's a lot of investment coming in and a lot of enthusiasm that is accompanying this investment. So we believe that this is a theme that people should be considering very seriously, right?
Okay, thank you very much. This has been really interesting. We have touched upon different themes all in the markets and many things to follow, but many things to be invested in, many opportunities. So thank you very much for this conversation, and we will be having more.
Of course, we expect to see you very soon. and there's going to be a lot of surprises coming your way. So please keep on following us, and we hope you have a great summer. For those in Europe, of course.
Enjoy.